Taxation of Salaried Employees. A presentation by Dear Accountant Business Solutions. The topics covered under this presentation are as follows. Details to employer, new or old regime of income tax for TDS on salaries. Tax rates under the new and old regime. Deductions not allowed or allowed in the new tax regime. Which salary is exempted from tax? Deductions available to salaried employees. New or old regime of tax, TDS. We would first like to start with the following example, which will help us to solve the queries asked by many employees these days regarding TDS on salary. Hey Rebecca, you look worried. Any problem?
Hi Rachel. Yeah, my HR told me to submit income tax saving declaration for FY 2021. He asked me to confirm whether my TDS has to be deducted under new tax rates or old tax rates. Do you have any idea about it?
Yes. According to the latest update given by the government, you are supposed to inform your employer about whether your TDS has to be deducted under the new scheme or the old scheme.
Oh, does that means if I opt for the scheme now, can't I change later during the year?
Yes, you're partially correct. Once you inform your employer about your decision, your employer will have to calculate your tax as per your option and deduct TDS throughout the year accordingly. However, at the time of filing the IT return, you have the option to choose under which regime you want to file the ITR.
Oh, is it? That means I also have the option to choose about new or old regime later while filing IT return. Do you have any idea about tax rate under old and new tax regime? Also, it is said that under new tax regime, we can't claim deduction, etc. Is it true?
Yes, under the new tax regime, certain deductions are not allowed. The tax rates and deductions cannot be claimed are as follows. Now coming to the tax rates under the old and new scheme. If your annual income is less than 2.5 lakh rupees, the tax rate under both the regimes is 0. That means you don't need to pay tax. If your annual income is between rupees 2.5 lakh to 5 lakh rupees, under both the schemes the rate of tax is 5%. Here, it should be noted that there is a tax rebate available of rupees 12,500 under both the tax regimes if your total income is below 5 lakh rupees. Thus, if your total income is below 5 lakh, wow, good news, no tax liability. Now coming to the next slab, if your total annual income is more than 5 lakh rupees to 7.5 lakh rupees, the tax rate under the old regime is 20%, whereas the tax rate under the new regime is 10%. If your annual income is rupees 7.5 lakh to 10 lakh rupees, then your tax rate under the old regime is 20% and under the new regime is 15%. If your annual income is above 10 lakh rupees and up to 12.5 lakh rupees, the tax rate under the old regime is 30% and the tax rate under the new regime is 20%. If your annual income is more than 12.5 lakhs and up to 15 lakh rupees, your tax rate under the old regime is 30%, whereas the tax rate under the new regime is 25%. Finally, if your annual income is more than 15 lakh rupees, the tax rate under both the schemes remains at 30%. There are certain deductions that are not allowed under the new regime. For example, Section 80C, LIC, housing loan, principal repayments, etc. Section 80D, Mediclaim insurance, interest on housing loan of self-occupied property, leave travel concessions, house rent allowances, professional tax, standard deductions of rupees 50,000, and all the other Chapter 6A deductions. Coming to the deductions that are allowed under the new regime. Interest on house loan, let out property, but loss can be set off in the next years only. Gratuities received at the time of retirement, employers' contribution to PF, NPS, superannuations, employers' contribution to pension under Section 80 CCD2, funds withdrawn from EPF account if withdrawal is made after a continuous service of 5 years, receipts from PPF account on maturity, withdrawal from NPS on maturity, leave encashments received at the time of retirement.
Oh, it looks like the old tax regime is better.
Not exactly. It may change from case to case. To know which option is better for you, consult your tax professional.
Also, do you have any idea about exemptions and deductions that are usually applicable to employees in case if I opt for old tax regime?
Yes, I can explain that to you. I would like to start by telling you which part of your salary income is exempt. Leave travel allowance, which is covered under Section 1015. Any allowances which is payable outside India by government to the citizen of India under Section 10.7. Gratuity under Section 10.10. Payment in commutation of pension under Section 10.10a. Leave encashments under Section 10.10AA. Retrenchment compensations under Section 10.10b. Voluntary retirement receipts under Section 10.10c. Income tax paid by the employer under Section 10.10cc. Receipts from Statutory Provident Fund under Section 10.11. Accumulated balance receivable from Recognized Provident Fund under Section 10.12. Receipt from superannuation funds under Section 10.13. And your house rent allowance. Now here you have to note that these amounts are not fully exempt. There are certain calculations for exemption amount which is mentioned in the Income Tax Act. Please consult your tax professional for advice. Apart from the exemptions mentioned above, there are also certain deductions that can be claimed by the salaried employees. One such deduction is the professional tax. Another deduction is the standard deduction of rupees 50,000 that can be claimed by every salaried employee. The third is interest on housing loan. Under the old tax regime, such a deduction is available for both self-occupied as well as let-out house properties. The limit for such deduction is rupees 2 lakhs for self-occupied and no such limit is mentioned for let-out house properties. However, set-off of losses can be done only up to rupees 2 lakhs. That means, in a year, in both cases, only rupees 2 lakhs can be claimed as a deduction for interest on housing loan. Any interest in case of let-out properties more than rupees 2 lakhs can be carried forward to the next years and set off. Now coming to the deductions under Section 80C. Investments in LIC policies. So you get a deduction for the premium paid on deferred annuity, contribution to Provident Fund. Here Provident Fund includes Statutory Provident Fund, Public Provident Fund and Recognized Provident Funds. Another deduction is a contribution to the approved superannuation funds, deposits in Sukanya Samriddhi accounts, subscription to NSC, contribution to the unit-linked insurance plan, contribution to approved annuity plans. If you subscribe to any notified units of mutual fund UTI, you will also get a deduction under Section 80C. contribution to notified pension fund set up by mutual fund or UTI, children tuition fees paid in India, repayment of a housing loan principal, stamp duty registration fees paid for buying of house property, 5 years term deposit with scheduled banks, 5 years post office time deposit, and notified bonds issued by NABARD. Apart from these 80C deductions, there are deductions under section 80CCC and 80CCD, which are contribution to specified pension funds and contribution to pension scheme notified by the central government, respectively. Putting together all these three sections, that are deductions under 80C, deductions under 80CCC and 80CCD1, the total amount of deduction cannot exceed rupees 1.5 lakhs. There are other deductions under section 80CCD2 that are employer's contribution to the notified pension scheme and a contribution to NPS notified by central government. Now, coming to the most commonly claimed deduction under section 80D. This is a deduction for the premium paid for the medical insurance taken by employee. Any premium paid for yourself, for your spouse or your dependent children, which includes the 5,000 preventive health checkup, the maximum deduction that you can claim is 25,000 rupees if you are not a senior citizen, and if you are a senior citizen, then the maximum deduction you can claim is up to 50,000 rupees. If you take the medical insurance for your parents, the total deduction that you can claim is rupees 25,000 if you are not a senior citizen, and in case of senior citizens, 50,000. Medical treatment expenses for disabled family member can be claimed under section 80DD. The total deduction that can be claimed is rupees 75,000. If the person has a severe disability, you can claim a deduction up to a maximum of rupees 1,25,000 rupees. Medical treatment expenses for dependent family members who's having serious diseases like cancer, AIDS, neurological diseases, etc. can claim a deduction under section 80DDB. Apart from these deductions, another most commonly used deduction is interest on loan for higher education, either for yourself or your spouse or your dependent children, and this can be claimed up to a total of 8 years. Coming to some of the deductions which are relating to loans, one such section is section 80EE. You get an additional housing loan interest deduction of rupees 50,000. An important point to be noted here, the total value of the house for which the loan has been taken should not be more than 50 lakh rupees. The loan should be sanctioned during the financial year 2016-17. Total value of the loan should not be more than 35 lakh rupees. Another important point is that you should not own any house on the date of the sanction of the loan. This deduction shall continue until the total repayment of the loan is made. Section 80EEA. You get an additional housing loan interest deduction of rupees 1,50,000. Here, the total stamp duty value should not be more than rupees 45 lakhs. This loan should be sanctioned during the financial year 2019-20. You should not have any house on the date of the sanction of the loan, and such a deduction can be claimed until the repayment of the loan continues. Section 80EEB, that is interest on loan for electric vehicles. An important point to be noted here, this loan should be sanctioned between the period 1st April 2019 to 31st March 2023. The maximum deduction that can be claimed is rupees 1,50,000 until the repayment of the loan continues. Section 80G. Any donations made to eligible institutions are eligible for a deduction. Not all donations can be allowed at 100%. One of the most important 100% donation deduction is donations made to PM Care. 100% of the total donation amount is allowed as a deduction. In case you make a donation to charitable trusts, you get only 50% of the amount as a deduction. Another deduction is Section 80GG, deductions in respect to rent paid. This section can be claimed only if you are not claimed HRA in the previous section. Full rent is not allowed as a deduction. There are separate calculations which have been mentioned in the Income Tax Act. Please consult your tax professional for advice on how much exemption can be claimed. Other deductions are donations made to scientific research, rural and research organizations, donation made to political parties, and such donations cannot be made in cash. Last but the most commonly claimed deduction is deduction under Section 80TTA, which is given towards your interest on saving bank deposits up to Rs 10,000. If you are a senior citizen, don't worry. There is another similar deduction under Section 80TTB, which is also towards the interest on savings bank deposits, and this deduction is maximum available up to Rs 50,000. So Rebecca, I hope I have clarified most of your doubts.
Yeah, you know so much about taxes.
Yes, for more clarity, you can contact your tax consultant. He might be able to help you better with that.
Thank you, Rachel. You clarified most of my doubts. Now I can work on this and inform my employer about my choice of new or old regime of tax.
You're most welcome, Rebecca. Also note that if you don't inform your employer immediately, he will automatically follow the old regime of tax. So be alert. So let me just go over the contents which have been already covered under this presentations. The first thing was the details to the employer, whether an old or new regime of income tax for TDS on salaries, tax rates under the new and old regime, deductions which were allowed and which were not allowed in the new tax regime, which part of your salary is exempted from tax, and what were the various deductions available to the salaried employees. So that's it for now, folks. Save yourself, save the nation. Stay home, stay safe, and pay your taxes. Thank you.